$606,000. That's the difference between investing $150 a month in a boring index fund versus investing the exact same $150 a month the way most Gen Z investors are actually doing it right now, picking hot stocks and trading in and out. Same money. Same 40 years. One path ends at $948,000. The other ends at $342,000. The gap isn't luck. It's math. And today I'm going to show you exactly where that $606,000 disappears. Meet Maya. She's 24, makes $58,000 a year working in marketing, and honestly, she's ahead of most people her age. She's got $6,000 in a Robinhood account and she actually invests every month, which puts her in rare company. Here's the problem. Maya's portfolio is 7 individual stocks she found on TikTok and Reddit, plus a little crypto. Last year she was up 40% for about 3 weeks and screenshotted it to her group chat. Then 2 of her picks dropped 60%, she panic sold at the bottom, sat in cash for 4 months waiting for the right time to get back in, and missed the rebound entirely. Sound familiar? This is exactly the pattern the Times reported on this week. Gen Z is powering the biggest retail investing boom in history. More of us are investing earlier than any generation ever. But the data suggests a huge chunk of us are doing it in the one way that's statistically proven to lose. Maya isn't failing because she's dumb. She's failing because she's playing the wrong game. And the cost of playing the wrong game over a career is life-changing money. Here's the mechanism, and I want you to picture a casino. When you pick individual stocks and trade in and out, you're a player at the table. Some nights you win big. Most nights, over time, you don't, because you're competing against professional traders, algorithms, and your own emotions. When you buy an index fund, you stop being the player. You become a part owner of the entire casino floor, every table, every machine, all 500 of the biggest companies in America. Individual players win and lose, but the house, the overall economy, has grinded upward for a century. Now here's the number that explains Maya's problem. Study after study, including the famous Dalbar research, shows the average self-directed investor underperforms the market by roughly 3 to 4 percentage points per year. Not because their stock picks are all terrible, but because of behavior. Buying after things go up. Selling after things go down. Sitting in cash waiting. Every one of those moves shaves off returns. And I know the objection, but what if the market crashes? Okay, let's take the worst-case example. Imagine you invested at the absolute peak in October 2007, the single worst possible day before the 2008 crash. If you just kept buying every month and never sold, you were back to even in about 4 years and massively ahead within 10. The crash wasn't the danger. Selling during the crash was. The market's job is to go down sometimes. Your job is to keep buying anyway. Now let's run the real math for you, not vibes, actual numbers. Scenario 1, you're 22, you invest $150 a month into a total market index fund, and you never touch it until 62. The S&P 500 has averaged roughly 10% annually over the last century. The formula is future value of a monthly annuity, $150 times 1.00833 to the 480th power, minus 1, divided by 0.00833. That's 480 monthly contributions. You'll deposit $72,000 of your own money total. Result at 62, approximately $948,000. You put in $72,000. Compounding did the other $876,000 of the work. Scenario 2, same person, same $150 a month, same 40 years, but you're stock picking and trading, and you earn the average self-directed investor's return, about 3.5 percentage points below the market, so 6.5% per year. Run the exact same formula at 6.5%, you end with approximately $342,000. Let that land. Same money in. Same timeline. $948,000 versus $342,000. That's a $606,000 gap, created not by how much you invested, but by how you invested it. And here's the kicker, the 6.5% scenario is the average underperformer. Plenty of people do worse. Maya's panic sell and wait move? One bad cycle like that can cost more than a whole year of contributions. So here's your one action step, and it takes under 5 minutes. Go to Fidelity.com or Schwab.com and open a Roth IRA. If you're under the income limit, this is the account where all that growth becomes tax-free. Then search the ticker VTI, that's Vanguard's Total U.S. Stock Market Index Fund, or FXAX if you're on Fidelity, which tracks the S&P 500. Buy $150 worth. Then, and this is the part that actually makes you rich, set up an automatic monthly investment of $150 on the day after your paycheck hits. Automate it so future you never gets a vote. That's it. No watching charts, no Reddit threads, no timing anything. If $150 feels like too much right now, do $50, the math scales, and the habit is worth more than the amount. You already have the one advantage no billionaire can buy, 40 years of runway. Don't trade it for the dopamine of stock picking. Quick recap, same $150 a month, 40 years, $948,000 in a boring index fund versus $342,000 chasing picks. The $606,000 difference is behavior, not brains. If this changed how you see your Robinhood account, subscribe. I drop one money idea like this every single day. And drop your money question in the comments. I read every one, and tomorrow's video might be your answer.